1929, 1965, and 2000. Those years marked some of the highest stock market valuations in modern history, and today we are at higher levels than any of those periods. Now, we all know that valuations are not a timing tool, but if we overlay the stock market, we can see that extreme valuations have done a surprisingly good job at signaling major market peaks. In 1929, that valuation peak was followed by an 80% drop in the market as the Great Depression hit. In the 1960s, it was followed by a decade of stagnation as stock market valuations were slowly repriced. And in 2000, the dot-com bubble burst and wiped out trillions of dollars in market value. What makes today even more fascinating is that these record valuations are happening right in the middle of an actual military conflict between the US and Iran. This is not how markets typically behave. During the Gulf War in 1990, for example, valuations were much lower than they are today. After the 9/11 attacks, valuations were also far lower. And in most periods where geopolitical tensions escalated or the world moved closer to a war, investors typically became much more cautious. Today it seems like we're seeing the opposite. And while that may look like resilience, it can also mean that the downside will be more painful when the sentiment eventually changes. This valuation metric combines almost every major way investors measure how expensive the stock market is. Things like the PE ratio, the price to book ratio, and even the famous Buffett indicator are incorporated here. The idea is to smooth out the weaknesses of any single metric and get a more accurate picture of how expensive the market really is. And so by almost every measure, US stocks are historically expensive today. There is simply no denying that. In fact, over the past 15 years, we've barely seen any meaningful valuation reset at all. Stock market valuations have just continued to climb higher and higher. Now, many investors look at this and say, well, maybe stocks actually deserve to trade at these levels today. And believe it or not, there is a lot of truth to that. If we look at corporate profits in the United States, they have indeed expanded higher together with the stock market. Over the last 15 years, corporate profits have more than tripled. This is one of the fastest profit expansions we've ever seen. For comparison, from the mid-1990s through to 2010, profits only grew by 100%. In fact, if we look a little bit closer at what has happened more recently, since 2020, earnings growth has actually kept up relatively well with stock market prices despite everything the economy has gone through. A global pandemic, the inflation shock and war in 2022, and even last year's trade war tensions. And now today, even with geopolitical tensions continuing to rise, corporate earnings are still trending higher. So not only is corporate America extremely profitable, it has also become resilient at generating earnings compared to most periods in history. So yes, it makes sense that investors are willing to pay higher prices for these extremely profitable and resilient businesses. And in theory, as long as earnings continue to rise, valuations can stay elevated indefinitely. But the opposite is also true. If corporate profits begin to roll over in any meaningful manner, that could absolutely have the power to reset these high valuations and create a lot of pain. So to get a clear picture of where corporate profits could be heading, we can look at corporate profits as a percentage of GDP. So in simple terms, instead of just looking at whether profits are rising or falling on their own, we're measuring how strong those profits are relative to the entire economy. And historically, this matters a lot, because the only moments where corporate profits have seen any sort of real drawdown over the last 70 years of data were moments where corporate profits contracted substantially as a percentage of GDP. We saw this in 2008 during the Great Financial Crisis, in the 1980s, and many times in the 1950s. Now today, not only are we seeing record corporate profit growth, but we're also seeing corporate profits becoming a larger share of the economy itself. Corporate profits now account for roughly 12% of US GDP. This is one of the highest levels recorded going back all the way to 1947. If this were to suddenly drop down to the historical average of 6% of GDP, this would very likely finally be the catalyst that could put significant downward pressure on stock market valuations. And the single most dangerous factor that could make that happen is this line right here. It is the corporate tax rate in the US. And we can see how closely these two lines have moved in the opposite direction over time. Starting in the 1950s, the US government steadily raised corporate taxes from roughly 38% to more than 50%, and this naturally put significant pressure on corporate profitability. Corporate profits fell from representing roughly 10% of GDP down to just 4% by the early 1980s. Now, in the 1980s, policymakers began shifting in the opposite direction. Instead of raising taxes, the government entered a long cycle of lowering the corporate tax rate, cutting them from around 40% back then to just 21% today. And this policy shift has very likely been one of the key factors responsible for the enormous expansion in corporate profits we've seen up until today. Now, let's say the corporate tax rate were to rise again, say back toward 35%, this would significantly reduce corporate earnings power, and the stock market could absolutely face a major valuation reset. And this may actually be a much more plausible scenario than what many people are thinking right now. Because if I can remind you, the US government is currently running a massive budget deficit right now. That means it's spending a lot more money than it earns. In theory, the government could choose to raise taxes to increase its revenue and help reduce this deficit. Now, doing so would of course mean putting a lot of pressure on businesses, reducing their profitability, discouraging investment, and likely slowing economic growth down, especially in the near term. But with the deficit and debt situation becoming more extreme every single year, it's definitely not absurd to think that this is a scenario that we should be expecting down the line. Now, the current administration under President Trump is still pushing to keep taxes low or even cut them further in order to avoid economic pain. So as investors, it seems that at least until 2028, the extreme profitability of corporate America and so the extreme valuations will remain. So while everyone is focused on wars, oil prices, recessions, the real story that could define the market today may simply be that corporate America is still operating under one of the most favorable tax environments in modern history. And as long as that remains true, today's market may stay elevated and expensive much longer than what most people think possible. For investors, this means market pullbacks may continue to be relatively shallow as we remain in a structural uptrend. So either staying exposed to a low-cost S&P 500 index, or if you're a more active investor, positioning yourself in the stocks and assets that are benefiting directly from this type of market environment. You see, when corporate profits represent a record chunk of GDP, our job as investors is to figure out where all of that money is going to end up being spent. And right now, a massive chunk of this capital is, of course, going right into AI. And the stocks responsible for building the infrastructure, supplying the energy, and providing the materials in order for AI to run are going to see incredible growth in the coming years. Roughly 40% of our exposure at Bravos Research is allocated towards a handful of individual companies in the nuclear power sector, energy infrastructure, and base metal mining that are directly exposed to this theme. We've released a full premium report diving into all of the details and revealing the specific stocks that we believe have the largest upside in 2026. If you want to find out more about this report, you can click on the link down below. Thank you for watching.